A company that lost $4.94 billion last year is about to ask the public to value it at $1.8 trillion. SpaceX, which has never turned a profit as a combined entity, filed for what would be the largest initial public offering in the history of financial markets, and within 9 days, a Danish pension fund looked at the numbers, looked at the governance structure, and basically just said no. Not just no to the IPO, no to the stock entirely. Academica Pension, which manages $25 billion for Danish academics, has placed SpaceX on its investment blacklist, barring every single one of its fund managers from purchasing a single share at any price near the target valuation. The chief investment officer called it grossly overvalued and said it suffers from a catastrophic governance structure. And this is not some fringe activist fund, by the way. This is the same institution that dumped $100 million in U.S. treasuries back in January, calling American government finances unsustainable. Over the past 5 months, one institution, has walked away from U.S. government debt, sold its shares in Tesla, and now blacklisted the biggest IPO in history. And it is doing it for the same reason every single time. The American financial system is becoming structurally dangerous for anyone outside. Before I go any further, this video is not financial advice. I am not telling anyone to buy or not buy anything. What I'm doing is documenting what European institutional investors are doing with their money and why, because the reasons connect directly to every story this channel has covered about the decoupling between Europe and the United States. If you've been following this channel's playlist on European decoupling, you already know the pattern across defense, payments, cloud, and software. This is the financial chapter. So here is what SpaceX is actually asking investors to buy. The S-1 filing, the document a company files before going public, revealed that SpaceX generated $18.7 billion in revenue in 2025. That sounds impressive until you see the loss, $4.94 billion. The year before, SpaceX made $791 million in profit. So what changed? Well, in February 2026, Musk merged his artificial intelligence company xAI, which owns the Grok chatbot and the social media platform X, into SpaceX. That merger imported $6.4 billion in AI losses onto SpaceX's books in a single year, and the bleeding is accelerating. In the first quarter of 2026 alone, SpaceX lost $4.28 billion, nearly matching the entire previous year's loss in just 3 months. The accumulated deficit now sits at $41.3 billion. So the only profitable segment is actually Starlink, the satellite internet service, which brought in $11.4 billion in revenue and $4.4 billion in operating profit. Everything else, the AI, the social media platform, the orbital data center plans, is burning cash at a rate that would bankrupt most companies on this planet. And here's the governance structure those investors would potentially be buying into. Elon Musk holds roughly 85% of voting power through a dual class share structure where his Class B shares carry 10 votes each, compared to 1 vote for the Class A shares being sold to the public. He simultaneously serves as Chief Executive Officer, Chief Technology Officer, and Chairman of the Board. He cannot be removed as CEO without his own consent. SpaceX has claimed controlled company status, which exempts it from the stock exchange rule requiring a majority of independent directors. It has reincorporated in Texas, which requires shareholders to hold up to 3% of outstanding stock just to bring certain legal actions. And it uses mandatory arbitration for shareholder claims, which means if something goes wrong, investors cannot sue in court. They cannot even join a class action. They go to private arbitration on Musk's terms. Academica Pension's chief investment officer, Anna Schelde, said investors are being asked to accept an unprecedentedly low risk premium for a highly uncertain company whose pricing appears to be driven more by narrative than by economic reality. The fund calculated that SpaceX cannot reasonably be worth more than $1 trillion, which is roughly half of what the IPO is targeting. At $1.8 trillion, the stock would trade at 96 times its 2025 revenue for a company that is losing money. If you're trying to understand how to read the difference between a growth story and a governance trap, my book, Awake the Practice of Critical Thinking in an Age of Self-Lies, is available as an ebook and audiobook. Subscribers get 10% off, and you can grab the first chapter for free in the description links below. Now, here's what makes this bigger than one pension fund and one IPO. Academica Pension is not acting in isolation. Back in May, the heads of CalPERS, which is the New York City Retirement Systems, and the New York State Commons Retirement Fund, which are American pension funds that collectively manage more than $1 trillion, sent a joint letter to Musk calling SpaceX's governance extreme and describing it as the most management-favorable governance structure ever brought to U.S. public markets at this scale. When American pension funds managing the retirement savings of teachers, firefighters, and civil servants are publicly warning that a company listing on American exchanges is structured to be uninvestable, that is not a disagreement about valuation. That is an institutional red flag about the integrity of the market itself. And this is where the European decoupling story connects. Academica Pension has now made 3 separate moves away from the U.S. financial system in 5 months. In January, it exited U.S. Treasuries entirely, with Shelter saying the U.S. government is not a good credit. That same month, a Swedish pension fund, Alecta, disclosed it had sold between $7.7 and $8.8 billion in U.S. government bonds since early 2025. Then Academica Pension sold its Tesla shares, citing Musk's destruction of the brand, and now it has blacklisted what is supposed to be the most exciting IPO of the decade. Each move individually is arguably small, but together they describe a trajectory. European institutional capital is systematically reducing its exposure to the United States, not because of one event, but because of the governance, the fiscal policy, the political instability, and the concentration of unchecked power have made the risk profile just unacceptable. So here's where I think all of this goes. SpaceX will price its IPO in the second week of June, and it will probably be over-subsidized because 30% of the offering is allocated to retail investors, and the Musk brand still carries enormous weight with individual buyers. But the institutional ownership base will probably be thinner and more geographically concentrated in the US than any comparable IPO in the last 20 years. I think at least 2 more European pension funds or sovereign wealth funds will publicly decline to participate before pricing, and the governance objections will probably become a permanent feature of how European institutions evaluate US-listed equities going forward. Probably within 12 months, the European Securities and Markets Authority will publish guidance specifically addressing dual-class share structures and controlled company exemptions in the context of cross-border investment sustainability. And the SpaceX IPO will be remembered not as the moment American capital markets proved their dominance, but more likely as the moment European capital started building a formal framework for deciding which parts of the American system it is still willing to trust with its money and which part it is not. But if European institutions are pulling away from U.S. equities and U.S. government debt, where is that capital going instead? Because Europe is building its own sovereign alternatives in defense, technology, and payments, and those alternatives need funding.